Okay, thanks everyone for coming to the very last session of the semester. Today, we're very happy to have Harry Crane, our co-organizer of this seminar from Rutgers Statistics Department, to talk about models versus markets, a case study of prediction markets and forecasters for the 2020 US election. Harry, the floor is yours.
Okay, thanks, Snow. Yeah, thanks to everyone for coming. And I should say before we get started well, I should thank Snow, who's been organizing the seminar and doing a lot of the heavy lifting, especially this semester as we've gone to remote. So thanks again for that, Snow, and I guess looking forward to next semester. So for this seminar, or for this meeting, I'm going to be talking about some work that I did this past election cycle, and I should take a second to say that this is joint work with Darian Vincent, who's in the room here. He's a student at Columbia who contacted me and was interested in working on this, and so glad to have had the opportunity. And so this is work that we did this year, but this also goes back a few years. So this is some discussion about political predictions, prediction markets, forecasts, and I'm going to talk about that specific problem, but also try to give you some of the bigger picture of why this is interesting to me and why I think it's an important problem, not just one that is specific to this particular application area, but one that I think is actually important it's an important case study for the rest of, I think it's for the way that science is conducted, also the way that science is communicated to the general public and internally among scientists. So the concrete question, the base case here that I'll be talking about is just the question of political prediction. So before an election happens, we want to know who's going to win. We still would like to know that perhaps in the current situation. So we want to know who's going to win, and I guess the question really is, who should we trust to give us a fair analysis or a fair opinion of what the likely outcome is. And so there's a number of outlets that we have. Of course, there are the pundits, there's the news media, people on TV, newspapers, also social media, which had a big influence on the past couple of elections. Then there's the pollsters and the so-called data journalists. That would be people like Nate Silver at 538, who use data, run analysis, and then they do some kind of journalism based on that data. They write about it and they write about the analysis. Andrew Gelman's also become involved in this. And then there are the prediction markets, which are a bit of a different, completely different and set aside from this, which are actual places that you can go to bet real money. There's people who do this professionally. There's a lot of people who do it recreationally. Places like Predicti, Betfair, and there are a number of others. And all of these outlets give some indication of who they have some opinion. If you look at them, there is some way of eliciting an opinion from them, and oftentimes they disagree. And so we might ask, well, who among these? The question really is, who among these is the most reliable? Is it these guys over here? Maybe not. I guess maybe not, depending. Is it the predictions, the forecasters? This is 538's forecast here. Or is it the people in the prediction markets who are putting their money, putting their money where their mouth is, so to speak. And so that's the kind of the concrete question that we're trying to analyze, trying to study here. At a higher level, and where this gets into the bigger picture, and actually where this question became interesting to me actually goes back 4 or 5 years ago to when we started this seminar. The seminar is on the foundations of probability, and it's a joint one with the statistics and philosophy departments. And 5 years ago, we were having an election at the same time, or at that time as well. And I remember seeing the forecasts. They were coming out of mostly out of 538 at that time. And I was having a hard time actually knowing making any sense of what they meant. What do these probabilities actually mean? And I think that it's it's actually quite a bit more difficult of a question than often gets credit for, because there's kind of there's a way in which the probability is calculated, and I'll give a very brief introduction to that in one of the coming slides. But what does it actually mean for the real world? You know, this 80% probability that at that time, this 80 or 70% probability that Clinton won the election. What does that mean in a single case scenario in which it's effectively just a number on a website? But what meaning does it have in the real world? And what really struck me about this is that I was actually sitting in our seminar in person back then, and it was several weeks. It was actually a couple months before the 2016 election, and I was overheard a conversation among some of the people in the room, and they were talking about how they were starting to get nervous because yesterday these people happened to be, I guess, supporting Clinton for that election. Yesterday or the day before, Clinton's chance of winning had been, say, 85%, but today it was only 75%. And so they were nervous because they were saying, you know, her chances are going down. And so there seems to be some real, you know, they seem to be giving some objective, real content to these reported probabilities. And I really wanted to I really had a hard time understanding what they actually mean. So I think that was an important question in the meaning of probability. Also, as we'll get to, and we'll see later, I think it's an important one in applied epistemology, the actual question of what do we know, how do we know it, and beyond that, do we really believe what we say we believe? And that's an important thing that I think separates the prediction markets from maybe people, maybe the forecasters, in particular the prediction market. In order to participate in a prediction market, you actually have to risk your own money. And so is there some kind of additional credibility that you get, or that the markets get as a result of that? And beyond that, what is the value of statistical models for all of these things, whether it's for predictions or political predictions or for other scientific types of inquiries? And how do these things apply in the real world, not just to political predictions, but to things like the response to the pandemic, or to the replication crisis in science, or to how peer review is conducted. So all of these things, I think, are related and can kind of could be discussed in this context, and I'll discuss them a bit at the end. But for the sake of, for the most part, I'm going to focus this conversation on how this relates to political forecasting, and in particular, this year's election. So if we were trying to get a handle on who was likely to win this election, not only I'm going to focus on the presidential election for this talk, but we could of course do this for the Senate, the House of Representatives, and so on and so forth. But if we were to look at some kind of an authority or some kind of expert, you know, which experts do we look to? And the two that I'm going to pit against each other here are the models or the markets. And so the models, this on the left is what the 538 site looked like on election day. This on the right is what The Economist looked like, that you can't actually see what their overall probability was for Biden and Trump, but they were giving Biden a 95% probability, Trump a 5%. And you can see that 538 was Biden 89% and Trump 10%. And so this 538 is associated to Nate Silver, and actually this year's Economist model at least it involved Andrew Gelman. Andrew Gelman was involved in the construction of that model, but he wasn't the only one. There were others involved as well. So those are the forecasts from the statistical models, and the prediction market. So here is this is what the page on Predicti looked like on the morning of the election. So you can see here that Biden was selling, and I'll explain exactly what this means for those who don't know. But if you just were to interpret these as directly as probabilities, probably shouldn't do that maybe exactly, but approximately they were giving Joe Biden a 64% chance to win, Trump a 44% chance. And in each of the states, you can see who they favored and with what probability or what price they were putting on a contract. So here we have, for example, for Trump was 63% to win Florida, 56% to win North Carolina. Biden was 60% to win Pennsylvania, according to the markets. This down here is actually a different market called Betfair, which is a much larger market, although this is actually a very small market. This is the Betfair site in New Jersey, not the international Betfair site. So there's actually very little money being put up here, only about $13,000 on either side. And this is in line with the predicted in that they are giving Biden, this equates to roughly a 51 or 52% probability. And I won't go into, it's not important here for where how these odds are to be interpreted for those who don't know, but it's giving Biden about 52%, Trump 48%. But I believe that this number was from about a month or two before the election. So this is a little bit of an old number. So the first observation that I want to make here is that the models have a very different outlook from the markets. The models are giving Biden a 90% chance, and the markets are only giving him, say, a 60 to 65% chance. And this was consistent across all of the markets, not just these two. And so it really does raise the question, well, maybe they must be using different information, or they must be interpreting the information differently at the very least. They might both be wrong in some way or another, but it makes it it becomes a bit hard to kind of justify or to reconcile how there's such a huge difference. And moreover, if these models were as accurate or as kind of credible as we believe, why you could just take these forecasts and you could put money in the market and you'd be making money. And so question is, well, why isn't that happening? The market doesn't seem to be adjusting to these forecasts. So really, what's going on here? So that's kind of the overarching question. So just to give a real quick introduction, and actually this talk is mostly not very technical. It's a bit more conceptual in how I like to think about this and why I think some of these questions are a bit more subtle than immediately meets the eye. But just to make sure everybody understands where these numbers are coming from, the forecasts on 538 or in The Economist, those are coming from statistical models that are estimated based on data, mostly polling data, but also other economic indicators and other types of data might be used. And so you can imagine fitting a model, and it's relatively complicated, and all the different data and the different structure of how the different states relate to one another in terms of correlation and so on and so forth. And then what 538 does is they simulate electoral college outcomes based on their model. And you can see, actually, it says right here, we simulate the election 40,000 times to see who wins most often. And they do that state by state, taking into account the correlation among the states. And then they report the proportion of times that Biden won and that Trump won in those simulations. And so in this case, Biden won 89% of the simulations and Trump won 10% of them. So that's how that number comes out. In the markets, it's very different. It's there are ways you can go into the market and buy what's either called a yes contract or a no contract, but we'll just talk about yes contracts. So one yes contract on Biden at this particular time was selling for 64 cents. And what that means is that two people, that there was a match at that point. So somebody said, I'm willing to buy one yes share for 64 cents, and somebody else said, I'll sell you one for 64 cents. And so that's why the market's showing that that's the price at this time. And what that price means is that this 64-cent contract will either be worth $1 or $0. So it'll be worth $1 if Biden wins the election, $0 if he loses it. Okay. All right. And so these prices offer an implied probability in terms of, well, how much would you, what percentage of the money is being bet on Biden versus Trump? And in this case, you see that the probabilities, the prices actually add up to more than $1, and that's reflecting some kind of market inefficiency that I'll talk about. But if you were to account for that and to just normalize probabilities to 1, you would get an implied probability of Biden 59%, Trump 41. Okay. So this again shows the discrepancy between the markets. So of course, if you were to compute the expected value of a Biden contract based on the 538 model, then that would be a very high positive expected value contract. And so if you were interested in making money, according to that model, you should buy shares on Joe Biden. Okay. And actually a lot of people were doing that. Okay. All right. So these are the two these are the two options that we have, at least for what I'm entertaining here. And there are arguments for and against both of them. Okay, so arguments for polls and models. So a lot of people argue in favor of statistical models and in favor of the polls, and they still do. Is that, for one thing, is that we know what the input is. At least we think we know what the input is. It's based on data. It's based on the polls. And the analysis is based on well-developed, kind of objective, in some sense objective, but at the very least, it's been studied and it is kind of well-vetted statistical theory and methods. Exactly how those methods are getting applied is a little bit ambiguous because of how complex the problems are and because of, well, just generally speaking, these methods don't actually get published in full detail. But at least in principle, they are well understood. And also in principle, these forecasts can be tested based on, using kind of standard statistical theory or tests and so on and so forth. The arguments in favor of prediction markets, on the other hand, are simply that there are very clear incentives for the market participants, right? Anyone who puts money into these markets has, at least without further without further information about them, they would have the incentive to make money. And so that's what so they should be acting, if they're acting rationally, that would be, well, one definition of rationally. There are other maybe rational ways to operate in these markets and not worry about making money. I'll discuss that in a second, but at least on its face, there should be a clear incentive for market participants to make money. It's a very objective metric. It's also a very easy one to understand. So we all understand at least we all kind of transact in money all the time. We might have different preferences or different concerns about money, and different risk profiles, but at the very least, we understand what it's worth or what a dollar is and all of that. There is a supposed wisdom of the crowds in these types of situations. This is a theory or just a general belief that markets are good at aggregating information, not because anyone in the market is particularly intelligent, but just that the market as a whole, the crowd as a whole is able to aggregate a little bit of information from here, a little bit of information there, and it settles on a stable price. And those prices tend to be pretty efficient in a lot of cases, provided that they're conducted under the appropriate conditions, or at least under conditions that are conducive to efficiency. And again, I'll talk about that issue of efficiency in a second. And then finally, there's just an automatic test. I mean, we don't have to cook up a fancy test for how the market's doing or how the people in the market are doing. There is just a test, which is how much money did you win or lose? Okay, and so there's not unlike in statistical work where you can kind of try to justify your analysis after the fact. Well, I didn't account for this or I didn't account for that, and if I had, it would have been better. You could kind of do that. You can talk your way through that you can make those excuses if you had participated in the market, but at the end of the day, you're not going to get any of that money back, right? You lose. If you lose, you lose. And so, quite simply, this is what it might look like right here. This is one of the portfolios I have from the election. This is what's left of it. A lot of the trades have already been paid out, but of what remains, as of right now, I've lost. I would lose $165 if I were to liquidate this right now, but that's the way the markets work, right? So it is a very clear-cut way of evaluating whether you're good at this or whether you're not. Okay. Now there's arguments against both sides as well. So what are the arguments against the modelers or the polls? Let's see, is that a question? If I should have said at the beginning, if there are questions, feel free to interrupt or interject at any point, rather than, to make sure that I can clarify, but I don't hear anybody, so I'll continue. So those are the arguments in favor of both, and the arguments against, there are arguments against both as well. So arguments against the pollsters and against the modelers, at least the one is, as I said, there's a bit of a lack of transparency, even though, at least in principle, that they try to be as transparent as possible. But if you think about it, well, for one, 538 is a private business, and they have very little, they wouldn't have an incentive to just tell everybody exactly what they're doing, or they wouldn't have much of a business left. But you can imagine that even if they did publish all of their models, and they publish as much of their data probably as they could, but they don't publish all of their model, their exact model. But even if they did, it would be pretty hard to evaluate, whether it's good or whether it's bad just by looking at it. In order to understand, this is a relatively complex data problem. In order to understand why certain, if I were to look at it, or I'm guessing if you were to look at it, unless you're very much in tune with this particular application, that a lot of the things they do are going to look like reasonable things to do. But that doesn't necessarily mean I can say that this is good or this is a bad approach, or that this approach is better than some other approach, right? It's a very difficult problem that only, I would assume, I believe only experts in this particular area would really be able to evaluate. And even then, I'm not so sure. There's also an issue of bias. I mean, there are partisan pollsters. They don't hide that. There are Republican pollsters and there are Democrat pollsters who, I don't know how that actually affects the polls that they conduct or the results of the polls, but they are at least presented as partisan pollsters. And there are reasons that one would want to promote a narrative that may bolster one of the two sides. It may disenfranchise, and these narratives can disenfranchise voters on one of the sides. And if they're very biased, they could harm the public trust in government and even in science. And I do think that that's actually one of the outcomes of this particular election. The polls, as we see down here, and I mentioned Flip earlier, Flip produced this graphic. This was a couple weeks ago. The exact numbers here, there aren't any numbers on this slide or on this picture, but at least what these colors correspond to. Dark red. So the more red a state is, the more underestimated the polls were in that state for that party. So this is telling us that this looks like Utah. Within Utah, the polls really by about 15 points underestimated Trump's support in Utah. In California, they underestimated Biden's support by, I don't know, 5, 6, maybe 10 points based on these colors. But if you look at this, except for 2 states, and if you look at Alaska and Hawaii, they were also underestimating Trump's support. So 48 out of 50 states were underestimating Republican support on the presidential election. And so there was a very large systematic polling error in this election. And that's perhaps a problem if we're going to want to trust the polls for giving us any guidance into what's happened. Because at least from my perspective, when I was watching this unfold in real time, knowing that I was analyzing this and most likely going to present this, whether it was in this seminar or elsewhere, I found it interesting because there were a lot of people who were saying, on the one hand, that the polls are wrong. And in some ways you say, well, those people in some cases were being dismissed because you say, well, the polls are wrong. And you say, well, that's wishful thinking because you want the polls to be wrong. And maybe that's true. But on the other hand, they turned out to be wrong, at least according to this picture, and by a lot of consensus is that they were off. And so what was it that kind of allowed some people to foresee that they were going to be wrong? And actually, I should say, if we go back to the markets, perhaps one justification why the markets were giving less of a chance to Biden, although they still favored Biden. They still thought he was roughly almost a 2-to-1 favorite over Trump. But they didn't give him a 90% chance, possibly because the markets were actually pricing in a polling error. So what was it about the markets that allowed them to see that didn't allow these models to see that? So that's just one possible explanation. But this gets to a further argument against models, and really what kind of maybe is one of my main gripes against these presentations, which is that I think that the models themselves as statistical models, I think are probably pretty strong, at least as strong as they can probably be based on what we currently know. I'm sure there's weaker models than others, and that's all fine. But if there to be some kind of objective content to this, there needs to be an objective metric on which they're measured, but there really isn't, and this allows for a lot of excuses and a lot of explanations that allow the forecasters to kind of wiggle out of any responsibility. So this was something that in 2016, even though Nate Silver, the 538, was giving Clinton a 72% chance of winning and that may have been the right number, I don't know, but the argument that was given in this blog didn't really analyze it from that perspective. They kind of just, if you go to look at it, this is simply statistics. This is by a statistician. His name's Raphael Irizarry. He wrote an article saying that not all forecasters were wrong. Silver got it right. And in 2020, actually, this was written before the election by Gelman on his blog. And he wrote that if you're trying to compare, for example, the forecasts that he was producing, which gave 95% to Biden, and he was asking, are these numbers too close to 100%? They seem pretty high. But he was saying, well, that's maybe not the right way to look at it, because by his, at least the way that he presents it, he's not trying to predict the outcome. He's not trying to forecast the outcome of the election, the votes as they're counted. He's just trying to forecast voter intention. And so he's taken something that in some sense is very concrete, who wins the election, and now he's abstracting away from it. And he's saying, well, I'm not trying to say who's going to win. I'm trying to say what the voters want. And I guess I would ask, I don't really know what the difference would be or what that means, but regardless of whether I can interpret it, it definitely is it strikes me as something that is kind of wiggling out of, well, just in case this doesn't go the way that I'm forecasting, I have this kind of alternative explanation. And so that's one of the real issues, is that the pollsters and the modelers that I have, is that they don't face that much risk for being wrong, especially when they all are kind of aligned with one another and in agreement that this was the correct way to analyze the data. So that's the argument against the polls. And then there's plenty of arguments also against markets. Just like pollsters can be biased, so can the participants in the markets. And there are plenty of people who argue that the participants in these markets, they have their own political biases, of course, and that there's a belief among many, I haven't seen an actual study done on this, but that there is just more conservative or more Republican money in the markets than there is Democratic money. I don't know if that's true, but this is what they call MAGA money. Okay, so the argument there would be that there is just such an imbalance in terms of the political preferences of the individuals in the markets, that even if the markets were in a much better situation relative to their own efficiency, which they're not, and I'll talk about that next, there's just too much sentiment on the side of Trump in these markets, and that's what's driving Biden's price down. And you could make a case that, I don't know if that particular argument is true or not, but you could make a case that political markets might be more subject to this than something like a sports betting market, where people certainly have their own preferences for who wins a particular football game, and they might be more inclined to bet on their own team, for example. But that's a little bit different than an election where not only do we kind of, we're of course, everybody's affected by the outcome of the election, but not only that, but we're all kind of participants in that election as voters and as, you know, people we interact with. And so there's a lot more emotion involved maybe, and maybe that's driving this, I don't know, but that's one argument. Another is that, of course, markets can be manipulated. There's some countermeasures against that in the particular market of Predicti, but this is now Betfair. This was Betfair. This is now predicted. I'm saying as of December 1st, and this is Betfair as of December 1st, and this is the real Betfair. So you can see that on December 1st, there was still this is the amount of money being bet or being offered for bets on Biden, which was 5.3 million versus, I guess, 1.2 million. So it's a good amount of money. And so there's definitely professionals, I would think, in these markets who are trading at this point, being willing to risk. They're risking a dollar to win $1.05. So they're willing to kind of risk a very large amount of money to get a very small return. That's something that usually mostly professionals are interested in doing. That's not the kind of thing that a recreational person would usually do. But you can potentially try to manipulate these markets. And I've spoken to professional bettors who actually have told me that they've manipulated the markets for their own purposes. They had their own, and this is going back about 20 years almost, to the Bush and Kerry election, where they bet $1 million or up to over $1 million even on Joe Biden or on John Kerry. Not because they thought they were getting a good bet out of it, but because they had believed and they had seen, based on previous debates, that when the debate was over, they saw that the pundits were looking at the betting markets to see who won the debate. And since they were a supporter of Kerry at that time, they wanted to try to float the market up and to make the market price go up on Kerry during one of the debates, to give the impression that Kerry was winning the debate so that it would be discussed on the news. Turned out not to actually happen that way. There was some discussion that the betting patterns appeared to be suspicious more than anything else. But that at least was the intention. And by doing that, by putting that money up, the price on Kerry went from being an underdog to making him a favorite for a short period of time in that particular election in that market. So the markets can be manipulated, but at least in that case, to manipulate the market, I'm getting a feedback now. It's somebody. Okay. At least in that case, to manipulate the market, the person who wanted to manipulate it had to risk a large amount of money to do so. So there is some kind of at least
Harry,
risk.
could I ask you a question?
Yes.
Back years ago, when I followed some of these markets, my understanding was there's a limit on how much you can bet each person.
That would be, yes, that's true in Predicti. And so that's where this next point will come in. That's not true on Betfair, I should say. So Betfair, there's no limits on or at least if there are, they're very high, and they might vary but there are people who have unlimited limits on those on Betfair.
So my other question was, you said something, you made a comment that there was something going on that you thought only a professional would do, and I didn't quite catch that. What was going on?
Okay, well, yeah, so these are related. So the next argument against markets, I'll explain, is that the crowds aren't wise. And the reason is, on the one hand, so there are obvious market inefficiencies, which are induced by what Glenn just brought up. On Predicti, there's a trader cap on each market, which means that at most 5,000 individuals can be participating in any given market. And so what ends up happening is that, and this happened this election, this happened 2 years ago, it happened 4 years ago, in the weeks before at some point, usually whether it's a week before the election, 2 weeks, it could be 2 days, whatever it is, the market becomes saturated with traders. So they reach that 5,000 trader cap. And what that means is that if I come in and I want to participate at that point, I'm going to get rejected and I won't be able to put my money into the market. And so that's one of the reasons why inefficiencies persist for a long time in these markets now, because what happens is that of those 5,000 people, maybe 4,500 of them bought shares on Joe Biden 6 months ago or on Trump 6 months ago, and they've forgotten about it. So they're not active participants. And so you're not, if I wanted to trade to make to balance out the market, they're not available. So now I have to trade with those other 500. Those are the only ones available. And so there's also just a block or a limit on who's able to participate. So it's the same people kind of transferring money, and there's no kind of new ideas or new opinions that are allowed to get into that market. So that's the cap on traders. There's also, as Glenn mentioned, a maximum risk, a maximum bet on each market. So on Predicti, that would be $850 per contract. So the most that I could go in and buy for Trump right now or whenever on any of these markets. In Florida, I could risk $850 on Trump, $850 on Biden. In Georgia, I could risk $850. I could do it in every state, but there is a limit in each of those markets. So if I came in, if I was a rich person or a professional, and I saw that something was really way off, and I wanted to invest $10, $20, $30,000, I can't do that. So that's a limit on the efficiency of the market. There's also transaction fees and commissions, and they're actually pretty high on Predicti. But the second thing that Glenn asked about, or the first thing actually, was that I said that a recreational bettor would be unlikely to want to risk, and I of course no single person is probably behind this, but there's $5.3 million being put up. There's $5.3 million being put up here to win 5% effectively on this on Joe Biden to win. Now, if Joe Biden was a sure thing to win, and you had any amount of money laying around, then to make 5% in, well, right now it's December 1st as of the time of this picture, but at the very least you expect the election to be decided by January 20th, which is when the new president will be sworn in. And so you're going to get a 5% return on your money in less than 2 months. That's a good return. But there's something in markets, Glenn and everyone else, which is observed in almost every market across the board, which is called a long shot bias. And the tendency is just that recreational bettors don't try to make 5 cents on the dollar, right? They try to bet on the long shot. They want to buy the lottery ticket to get paid. They don't want to get paid 5%. They want to make 50 to 1, right? They want to put in a small amount and win a large amount. And so there tends to be a bias in these markets towards those types of things to the point where it's actually profitable to bet in these very small margin situations, precisely because there tends to be more recreational money on the other side of those bets because they're trying to hit the big score. But I guess to answer Glenn's question, this is speculation on my part, but 1 month after the election, I wouldn't expect somebody to be willing to put up a very large amount of money on Biden to win in this market just because they like Joe Biden and they hope he wins, because they have very little upside to that. They're making very small amount of money, and also the election happened a month ago. So these are, I think, most likely people who are doing this professionally, and they're trying to kind of clean up those extra percentages that they can add to their profits. That's just speculation. Does that answer your question?
It gives, yes, I understand yes, it does answer my question.
Okay, so finally on this slide, this, as I said, was December 1st, which was a couple days ago. And as you can see, these don't agree perfectly either, but there's reasons for that related to the inefficiencies. We'd probably expect Betfair to be more efficient. For sure, I'd expect them to be more efficient than Predicti. But even Betfair, with all of this volume, is still appears to be giving Trump a 5% chance to win. Over here, we have Trump getting an 11% chance to win. According to the media, according to a lot of people, the election's already over. So What's going on here? Is it, well, on the one side, maybe it's not over. Maybe, is the chance that the legal argument or the Supreme Court, all of that stuff, is the chance of that coming through actually 5, 6, 7%? Maybe it is. Or is it like the naysayers, or the people who don't like the markets or who criticize them say, is it just that these are just, kind of a bunch of people who are still holding out hope that Trump pulls it out, and that's what's artificially inflating this price, which is, according to them, ridiculous that it's still giving a 10 to 11% chance that Trump wins, even after all the votes have been counted. Okay, so those are the two sides of the story. Those are the opinions. Okay, and so what I'd like to do is and what we did is we actually are looking at, well, how did they actually do? The election's actually over, and we can look at how, on the state-by-state basis, did the prediction markets do versus how did the forecasters do. And there's several metrics you can use, and we're going to introduce our own metric, but there's several kind of conventional metrics, and they are the usual ones are called calibration and accuracy, and we've talked about them in the seminar a number of times. Calibration essentially is just unbiasedness. So a forecaster is calibrated if 10% of their, when you say, when I say something is X% to happen, then it will happen X% of the time. So 10% of my 10% predictions happen, forecasts happen, 20% of my 20% forecasts happen, and so on. Accuracy is closeness to the truth. So not only so calibration would be that my forecasts are happening with at the right percentage of the time, but accuracy is saying that actually when I say that something is likely to happen, it tends to happen. So a perfectly accurate forecast would be one that always predicts that when I say something, I predict 100% on things that happen, and I predict 0% on things that don't happen. But if I were to say 90% and the event were to happen, then that would be pretty good. That would be a pretty accurate forecast. Whereas if I said 90% and the outcome didn't happen, then that would be a very inaccurate forecast. So there's measures for that, particularly proper scoring rules. And I'll use one particular proper scoring rule called the Breyer score later on just to illustrate this idea. But this won't be our main way of evaluating this. So there are some drawbacks to this, to these metrics. Of course, calibration, first of all, doesn't imply accuracy. You can be perfectly well correlated. It doesn't mean that you're in any way accurate. And there's some very interesting work on this by Glenn and his co-authors on defensive forecasting, which actually gives you a way of forecast, which shows a way that you can actually forecast without knowing anything, actually. With basically the only information you use is your past deviations from calibration, and you, in essence, what you're doing there is you're using your past deviations from calibration to, in some way, overcorrect, so that overall you average out and you end up looking calibrated, even though you're not actually producing anything kind of meaningful. At least that's my interpretation of it. Glenn may have another, but that's how I've come to understand it. Accuracy is something that's talked about a lot in statistical work, at least statistical work on forecasting. It's a bit abstract, though. Breyer score is a particular measure that many of you know, but if you don't, you can imagine if the event happens, you assign that to be value 1. If it doesn't happen, you assign that to be value 0. And the score for a given outcome would be 1 minus the probability squared. So if I had a 90% probability on something that happened, then my accuracy score would be 1 minus 90% would be 10% squared. So it'd be 0.01, 1%. So that would be pretty accurate. So that's one particular measure of accuracy that's called the Breyer score. But it's a pretty abstract in terms of how that actually relates to anything in the real world. Does being accurate in the real world actually mean much? What does it mean? And there's always the question of accurate relative to what? And here I just show this graphic. This is actually a graphic from the 538 website, which has a part of its site which actually tries to evaluate how well it performs according to these metrics of calibration and accuracy. And as you can see here, so they compare themselves to what they call the unskilled forecaster. And what the unskilled forecaster is somebody who goes into every outcome and just assigns 50-50 to every possible outcome. So in a baseball game, they're going to give 50% to both teams. In an election, they're going to give 50% to Trump, 50% to Biden. Not only are they going to do that in the overall election, they're going to do that on a state-by-state basis. So they're going to go and they're going to look at California, and the unskilled forecaster is going to say that it's 50% for Biden to win California and 50% for Trump, and Alabama 50-50. And so you can see that according to this this metric, 538's forecasts farther to the right is that they're doing a lot better than the unskilled forecaster. They're showing that in their political forecast, they're very way outperforming according to this accuracy measure. But of course, the way that I just described it, you would hope that they're a lot more accurate, because any one of us would be much better than that unskilled forecaster without using any kind of data, right? On any given election cycle, probably 40 of the states or even more are easy to predict with incredible accuracy. And so this unskilled forecaster is a bit of a straw man in this case. So if we want to measure accuracy, we should probably have a stronger opponent than the one that's given here. Okay. So just to kind of bring this full circle, I want to show, I don't want to dwell on these tables and numbers, but I want to show that at least we have looked into this. We can look at calibration for 538 and for the markets. And if you look at the calibration table, so what this is I just take bins. So every time that they forecasted something between 0 and 5%, or the times that they forecast between 5 and 15, 15 and 30, and so on. Of all those times, this is the number of times that they expected the outcome to happen. So this is the number of expected outcomes according to their forecasts. And this is the number of actual.
This is sports and politics and everything.
No, I'm sorry, this is for the 2020 election. But this is for the Senate, House, and President. Okay. So this is the calibration for 538's forecast based on the 2020 election of Senate, House, and state-by-state electoral college outcomes in the presidential race. So if there was so this is the number of times that 538 expected. This is the number, if 538's model was correct, this is the number of times we would have expected certain outcomes to occur. This is the number of times they actually occurred. And so you can kind of compare the frequencies, the actual frequency versus the expected frequencies. These are the z-scores. I don't want to go into the actual, these are very basic statistical calculations, but if anyone has any questions about them, I'm happy to answer them. But the bottom line point of this table is that actually you can, if you do a chi-square test, which based on these outcomes, the chi-square p-value is about 99%, which is saying that this is very much a well-calibrated forecast. Okay. There is no evidence against calibration here, essentially. You can do the same thing for Predicti, and Predicti had less markets, so I can only use the markets that I have that they had. So there's a bit of a smaller sample size, but still big enough to get a table. And there's a little bit more discrepancy, but still, it looks pretty well calibrated. Chi-square, the p-value 89%. None of these are even close to significant. So you can look at them side by side, but there's really nothing to see here, more or less. They both appear to be pretty well calibrated. And the question is, well, what does this prove, if anything? Okay. I don't know. Okay, but that's the calibration calculation. So both are calibrated. Is one better than the other? I don't believe that it's really possible to say based on this. Okay. We can also do an accuracy analysis. This is based on the Breyer score. And if we were to do that based on all of the races, then 538 does come out with a better Breyer score. So lower numbers are better. So 538 has a lower Breyer score, a better score than Predicti. But if we were to remove all of the, so I'll explain why I do this in a second, but if we were to remove all of the races, whether it's in the Senate, House, or in the president, where the predicted outcome, the forecast is 95% or above for one of the candidates. So in California, that's actually a bad example, but in California, if the prediction that Biden was going to win California was 96%, say, even in the prediction market, even though that itself is pretty low, we're going to throw that out, and we're going to only use the races, only use the states where the forecasts were somewhere in between 6% and 94%. And if we do this, then we see that it draws about even. Predicti takes a very small, but I would say an insignificant lead. And the reason why I at least I wanted to take a look at that is because of what I mentioned earlier with the long shot biases in these markets. On the morning of the election, you could buy a share for Biden to win California at 94 cents, which is pretty much a guaranteed 6% return if you ignore transaction costs. So that's a pretty good return on a one-day investment. The problem, of course, is that it's a maximum $850 investment, so there's really not that much upside there. And the other issue is that when you factor in transaction costs and commissions, that 6% return actually turns into about a 0.4% return, which explains how, first of all, how bad the transaction structure, the commission structure is on Predicti, but also how these commissions are affecting the efficiency of the markets. I have no incentive to take money out of my bank account and put it on the site to make that 0.4% return on $800, right? Whatever that comes out to be, $3 or $4.
So these commissions, Harry, I assume they're paying for maintaining the site and maybe making some profit for the people running it. But is that the explanation for why these numbers sometimes add to more than one?
Well, that's not directly, the commissions don't force the numbers to be bigger than one, but that's more or less a reflection of the inefficiencies in the market and the fact that the markets are in balance. As far as what these commissions get used for, Flip, I don't know if he wants to say anything on this, but he would know better than me. But I really think it's a way to make money. I mean, they're making good money off of this stuff.
So to ask my question, well, I'll just ask my question in a different way. Do the commissions in general make it impossible to make money off the fact that the numbers add to more than one?
Oh, I'll explain that. And I think the answer, well, to that question is that the fact that the probabilities add to more than one is not it only makes it harder to make money. Right? If the probability is added to less than one, then there would be a.
Okay, thanks. I understand now. Okay.
Yeah. Okay.
Harry, do you want me to weigh in
Flip,
real briefly?
Yeah.
Yeah. And so the way the commission fees work too is it's sort of lopsided. So it's charged only on profits. You pay 10% of realized profit. So in other words, there's not risk-free arbitrage available until the aggregate pricing goes to 110 cents. So you'll often see the aggregate fee somewhere between 100 and 110. There's also sort of persistent and well-documented long shot bias too. So even though the presidential is basically binary, at least toward the end, early on in something like a nomination market, you'll see several of the really super long shots all trading at 5-6%, even though they probably have a sub 1% probability. Likewise here, even when it's binary, if Biden's trading at 65 and Trump is trading at 40, it probably means that more of the aggregate overpricing is in the underdog. Again, just because there is this sort of persistent tendency of prediction market traders to overfavor an underdog or to throw money on, not lotto tickets in this case, but long shots over favorites.
Okay, yeah. Okay, so thanks for that. Yeah, so there's a lot of barriers to the efficiency, but in any case, you can read into these accuracy numbers as you wish. By this metric, in some sense, yes, 538 is more accurate than predicted. Most of that additional accuracy, though, is in the tails of is on these very low probability or very high probability events, and those are explainable by known inefficiencies. So since there are known inefficiencies, I would say that I don't really consider that a huge benefit of the 538 models, because I can not know anything about 538, go to predict it. When I see 95 cents, I know that really most likely means something like 98, 99%, but it's being drugged down because of the inefficiencies. Okay. The other thing is that, just for comparison, I thought, think back to this unskilled forecaster in the previous page, where they just assigned 50-50 naively to every race. Well, I thought a naive but a pretty good starting point for a forecast would be to say, for every state, I'm just going to predict the winner of that state to be the same party who won it 4 years before. So this year, I'm going to predict Trump to win Florida, North Carolina, Pennsylvania, Wisconsin, Michigan. I'm going to predict him to win those, and I'm going to predict Biden to win all of the states that Clinton won in 2016. If I were to do that, and I were to just assign 100% probability to those outcomes, then how many states would I get correct in a given year? And you can look, and if you can, I actually did this back to, I think, 1980 or even before that. But if you just look at the past 5 elections, you'd be predicting somewhere in the range of 46 or more correct, except for in 2008, which happened to be a pretty anomalous year. But another thing that I noticed in looking back at this is that years with incumbents tended to be more accurate. 49 for Obama, although 46 for Trump was pretty low, actually, assuming that everything holds the way that it's currently projected to hold. That is, so that would be Trump losing Pennsylvania, Michigan, Wisconsin, Georgia, and Arizona. So he would have lost, and this is out of 51 because of Washington, D.C. But if you were to do that, if that were to be your method, then your Breyer score would be 9.8% for this year, just using that very naive approach, as compared to, say, 7% or 10%. You'd actually have been better than predicted overall.
I have a question.
Yes.
So the heuristic to use the previous election is as good as doing using the forecasting polls or the market.
Well, I don't want to say it's as good. It certainly has drawbacks, or potential drawbacks. It's a pretty naive thing. You wouldn't want to just use information from 4 years ago. There's always, you could update your information from 4 years ago, but I think that's a good starting point. I think is my point, is that one of the things I would say is that in a given year, 538 might correctly predict 47 or 48 states correctly, if you just take being over 50% to be predicting it correctly. Well, that often gets reported as saying, well, they predicted 48 out of 50 correct. That's really good. But if you think about it from this perspective, you're actually starting from a baseline of about 42 or 43 correct, because that's something that anybody could have gotten right. You didn't have to fit a very expensive and fancy statistical model. You could have just used common sense. So the question is, definitely, I think there's extra value in these markets, because they're fine tuning. They're not saying, well, it's either 1 or 0. This person's either going to win or they're going to lose. They're giving you a probability. They're giving you a forecast that, well, they're very likely to win, or maybe it's uncertain, it's 50-50. So I do think that there's potential value here, but I'm just giving this as kind of a baseline to try to put some of these numbers in perspective. And I would say that they're in the same ballpark as this naive estimate. So I would say they're not necessarily doing a whole lot better. Actually, the 538 number is considerably better, although I don't have any kind of statistical uncertainties on these. maybe I should, but this is really just to give a ballpark estimate or a rough idea.
Okay.
Okay, and then finally, there's no point in dwelling on this, but if you were to be a little bit more sophisticated than this and to say, well, let me identify the 10 toss-up states. Everybody knows that Alabama is going to go to Trump and California is going to go to Biden, but there's 10 states that we really don't know who's going to win. Florida, we don't know who's going to win. Pennsylvania. Let me just assign 50-50 to those states, and I'll just assign the 100%, 0% to those other states that everybody knows who's going to win. In that case, I would have gotten a Breyer score of 5% for the 2020 election. So I should point out, this is according to Breyer score. This approach of assigning 100% probability to an outcome would really perform horrible if you were to use something like the log score, because you would have predicted Trump to win Georgia with 100% probability, and then he would have lost, and that gives you a negative infinite score. So that wouldn't be something that you should do, but this is just a point for illustration. Okay. So these were the two kind of basic, classic measures, and I would say they're pretty inconclusive in terms of who's better. But more importantly, from my point of view, they don't really tell, even if we knew somebody was better according to this metric, do they really tell us anything about the value that they add to real world understanding of what's going on? And so the premise of what we introduced in this work, and something that I suggested earlier back in 2018 election, and I started this back then, and I did it for that midterm election, is what I call market-based scoring. So we have a market. The market is the prediction market, and those prices, that exists independently of any kind of analysis that we do. And so the premise of this scoring system is just to say that a forecast adds value over the market if it can beat the market using any kind of reasonable investment strategy. And that's a little bit of a vague explanation, but the point of this is that we have to specify what the strategy is before the outcome happens. We have to specify what strategy we're going to use in October or in June, not in December, and say, well, if I use this strategy, it would have won. So it has to be in some sense pre-registered. And that's the one thing about people who participate in markets are forced to do this, because you can only buy something in a market before the outcome happens. Otherwise, the markets are dried up. You're not going to make any money doing that. So just to explain what this is, I think it's pretty intuitive, but there's a forecast on the 538 website, for example. You could do this with any forecaster. And this is actually how you would get graded if you were actually a bettor in these markets, is that for any given event, say Biden to win Pennsylvania, there's a forecast P that is assigning a probability that event happens. So as I showed earlier, there was a 60% forecast that Biden was going to win Pennsylvania. And there's a cost for buying one contract on that event. And in this particular, no, there wasn't a 60% forecast. The forecast, according to 538 for Pennsylvania, was probably something in the range of 70 or 80%. I don't remember off the top of my head. But then there's a cost of buying that contract, which was 60 cents on Predicti. So according to the 538 forecast, it was actually it would be profitable to buy the yes contract on Pennsylvania, Biden to win Pennsylvania. But what we do in this case is we specify a strategy, and the strategy is just a function of, it can be a function of other things. It can be a function of how much money you have. It can be a function of other variables. But for the sake of this, I'm just going to make it be a function of the forecasted probability and the cost of the contract. And this is going to tell me how many shares that I'm going to buy or sell under any possible condition. And so one example, and so we specified in my paper with Darian, we specified and we studied two specific strategies. We could have picked others, but this is what we picked, and we picked it before the election. So we wanted to make sure that there was no kind of post hoc adjustment. We wanted to make sure it was registered before the election. So we did something which we call dollar cost averaging. This is a common investment strategy for in retirement accounts, for example, where we're going to buy some fixed number of shares if the contract is undervalued according to our forecast, and otherwise we're going to just sell all of our shares. So in this case, I would buy one share or maybe 100 shares, whatever the number is, Well, actually, this is not dollar cost averaging. I'm going to buy a fixed amount of money's worth of shares if the contract is undervalued. So I'm going to take $100, and every single time I see that it's undervalued on a given day, I'm going to buy $100 worth of shares. So when it was selling for 60 cents, I'm going to buy somewhere in the range of, let's say, 17 or 18 shares, whatever the number is. Or it's more than that, but it's not 17 shares. It might be 170 shares, probably. Somewhere in that range. Okay. Otherwise, I'm going to sell all the shares that I have. Or you could get a little more sophisticated. You could scale the amount you invest according to how big your advantage is. This is something called the Kelly criterion, which takes into account the fact that, well, if I assign probably 61% to Pennsylvania and it's selling for 60 cents, I'm going to invest a lot less than if I'm assigning 90% to Pennsylvania when it's selling at 60 cents. And actually, when I have a 61% probability on Pennsylvania in that case, I'm not going to buy anything because of the transaction costs. But that's how the Kelly criterion works. Now, one caveat for those who are tuned into this is that the way that we applied it in our analysis is technically not the correct way to do it, but because in order to correctly apply this in this application, you would have to account for the correlation among all of the different states. And there is a way to do that, but we don't actually know what the model correlations are. So we don't get the full joint probabilities from the 538 analysis. So it's not that we couldn't do it. Well, it's not that we didn't know how to do it or anything like that. It's just that we couldn't do it because we didn't have the information at our disposal. But in any case, I think that this at least gives some flavor of what we're after with this type of scoring approach. So just to give some specifics about the analysis, as I said earlier in the discussion beforehand, we built an app, and it wasn't really me. It was Darian who built this app, which you could go to at this site, and you can play around with how the portfolios performed in the lead up to the election and then after the election. Okay. And what's actually interesting about this is that I will say that by looking at this, there was kind of a clear upward trajectory of all of the portfolios before the election happened. And so that what that actually suggests is that the 538 was incorporating polling information perhaps more efficiently than the markets were. So that in some ways the markets were reacting late to certain information. But then this was the week before the election, then this was the election. There was a bit of a crash, and it kind of corrected in some cases. So basically, 538 seemed to maybe have an advantage in aggregating information before the election, but they weren't necessarily, well, as we'll see, more accurate or better in performing according to these metrics, and actually in terms of actually making money. So we applied these dollar cost averaging and Kelly strategies. We did it to all markets available for House, Senate, and President, and we updated the portfolio allocation every day. Okay, so before I show I'm going to show the results on the next slide, and before I do that, I want to say, well, like I said, just like I argued for the others, there are arguments for and against market-based scoring. Arguments for is that there is again, a very clear metric. You know, we don't have to, I should say, this was a pre-registered analysis. I don't know if I mentioned that. Yes, so this is something that I know that people are big on this in certain scientific fields, but I think it's especially important here because we posted our intended analysis online prior to the election so that no matter what actually happened, the tests that we were going to run were actually already stated. So none of these were chosen kind of after the fact. Okay. So the main argument in favor is that there's a very clear metric. It's concrete and it has a clear interpretation. Did you make money? Would you have made money or would you have lost money if you had just taken the forecast on this website and put money into the prediction markets, according to the strategies that we specify? And on top of that, and this is something that I think is very important, and I've written about it elsewhere, I've talked to Glenn about this. Glenn presented a paper at the Royal Statistical Society earlier this year on some related ideas, and perhaps those will come up in the discussion. But I think that the big difference and the thing that is really important, I think there have to actually be concrete consequences for whether you're good or bad at forecasting. And actually, according to our this scoring method, there are still no consequences because the way that we've run the analysis, nobody's actually losing money according to this. This is just kind of a hypothetical. So there is still, I think, a pitfall there, but at least in principle, you could test according to this. But the arguments against is that there are some who argue that it's unethical to bet on publicly available forecasts. That's what Nate Silver says. I think that itself is actually an unethical position, but I don't want to get into that. But there are people who believe that. There was Gelman's point that this is kind of an apples to oranges comparison because the people in the markets are definitely trying to forecast who wins because that's how the market gets decided and that's how they make money. But according to his discussion, he's not trying to forecast the election outcome. He's trying to forecast something called voter intention. And another thing, Nate Silver, a lot of people insist that the markets are just dumb. So why should we bother trying to validate our models against them when they're obviously very wrong? And there's a couple of, these are tweets by Nate Silver leading up to the election. This was even just recently, that political betting markets have become so dumb as to perhaps be a contrarian indicator at this point. And so there's some harsh language and some bold claims, I would say. But the one thing that our scoring method is intended to get at is, well, are these claims actually true? Okay. And so, again, it's actually a little bit of a matter of interpretation, but these are the numbers that we get. Okay, so these are returns on investments. So for every dollar you put in, how much money would you have pulled out of the market? So if it's plus 5%, every dollar I put in, I get $1.05 back. Okay, if it's minus 5%, every dollar I put in, I get 95 cents back. So I've broken this up just according to the presidential, Senate, House, and total, just overall, I should say, which is the aggregate of President, Senate, House. And what I've actually broken this down is according to the assumption that there are no fees, the assumption that there's just a commission on a trading commission, and the assumption that there's a commission and a transaction fee. So this is getting at some of the imperfections, not necessarily in our analysis. We can only kind of deal with what we're given, but in the reason why predicted or prediction markets in general may not be so such a perfect competitor to these forecasts, because there's several sources of inefficiency, and those inefficiencies can be rather large. So let me explain this. So if we assume there are no transaction costs, actually, even in the House and Senate, you would still have lost according to the Kelly criterion. You would have won according to this strategy, and you would have theoretically made money according to the 538 model. However, that's not really, I would argue, that's not a very fair way to compare, because without accounting for fees, we're not really competing against the market properly. The market has these inefficiencies built into it because of the fees. So if we don't account for the fees, then we're able to take advantage of those inefficiencies without having to pay the costs that causes the inefficiencies. So the example being that California is selling for 94 cents on election day. Without accounting for fees, I can theoretically go in, clean up that 6%, not pay any transaction costs, and that's helping out this value here. When in fact, when you take into account all of the fees, as I said, 6% goes to some kind of 0.4%, something very small. And so actually, when you start to take into account these sources of inefficiency, you start to see that actually in the end, after all of the fees are taken into account, 538 would not be very competitive in this market if you were to just take their numbers and not do anything different. They would lose somewhere in the vicinity of 3 to 4% to 5%, which is a very large loss according to it's a very bad return, right? If you're playing craps in a casino, the return is something like the house edge is something like negative 0.4%. So the house wins 40 cents on every $100 that you bet. In this case, you'd be losing between $3 and $5 for every $100 you bet. So the moral of the story is maybe you can try to interpret these as charitably as you'd like, but if you were actually asking the question, could I make money by just taking the forecast, whether it's on 538 or The Economist or anywhere else, and the answer is, well, according to this analysis in the 2020 election, if you were using any of these particular strategies, the answer is no. Okay. Now, that's not to say that there's no way to make money in these markets. There's plenty of people who do it, and there's plenty of people who actually use the 538 forecasts as part of their tools in doing so. But you have to massage them. You have to use them more intelligently than just blindly following what they tell you to do. That's kind of where the art comes into it, I suppose. Okay. So I see there might be a question. Kenny, is that you?
Yeah, I was going to ask if there was just a simple modification of either of these criteria, because they lose money when you track the commissions and fees, and I wasn't quite clear on the way that you were spelling it out. If the algorithms paid attention to those commissions and fees in determining when it was profitable to buy and sell, or if you would hold your position when those things would make the margin.
These are supposed to be taking into account those fees. Yes. Of course, you should always double check that, but yeah, definitely.
Yeah, they do. The code was calculating the expected value based off of the Kelly criterion with the fees included. So it should, when it was figuring out whether buying or selling was worth it, it was doing that.
Okay, so there should be some range of prices within which it wouldn't change your position, even if the market had moved that day.
That's right. Yeah. So that's exactly right. So is that I think that answered your question, right? Yeah. Okay. All right. So the concluding remarks on this, and I have about 2 more slides just to kind of put this again in the bigger perspective before I stop. At least according to our analysis, the models don't beat the markets. I don't know if we should really expect them to. Again, I think that there were a lot of bold claims out there that the markets are dumb, or that of course the models are much better. But I don't actually hold that opinion. I think that markets should be respected unless I know something, unless I'm somehow smarter, and I certainly don't think that I'm smarter than these markets. At least in general or overall. But should we expect them to? I mean, the forecasts that are put on these websites are publicly available, and the traders in those markets are able to use them in deciding whether to trade. So it's almost like the forecasts get fed into the markets, but there's nothing stopping the forecast from taking the markets and using them as well. But I would say that in some ways, though, the models are competitive based on the abstract metrics that we talked about, but they're not necessarily competitive based on the real metric of profit and loss. That being said, the market should definitely be better. They aren't necessarily as dumb as some people claim, but they aren't really as sharp as they really could be, and that's, I think, a result of all of the inefficiencies. And then this is going to lead me to the next couple of slides and to the bigger picture here, which is that I think the overall, or at least my general opinion on this and conclusion here is that the pollsters, the data journalists, the pundits are, in gambling terms, doing what's called a free roll. They're free rolling the general public in the sense that you can argue that there's reputational risk involved, but based on what I've seen, at least over the, year after year after year, whether or not they're right or wrong, there's really no clear way to judge whether they're right or wrong. So they're always able to kind of argue, well, we were right for this reason, or we were wrong because the polls were wrong, but the polls were wrong because of this. So there's always kind of a way to talk their way out of it, and that tends to be what they do. But if they would have beaten the markets, they could always say that they would have, but without actually having to have risked the loss if they wouldn't have. And so I think that is and I talked about this in the discussion of Glenn's paper. This is to me, a big shortcoming, even of our analysis, because I'm doing an analysis as if you had invested in the market, not actually having done it. But I think this is a shortcoming of any hypothetical testing by betting type of approach without actually having real bets. If we're just pretending to do these things, it really is just pretend. And that's what gets me to the final couple of points. This is how this fits into the bigger picture of this, which statistical analyses of all kinds pose risk to society. Decisions that are being made about the pandemic, medical decisions, public policies, and so on. But those risks aren't really necessarily always shared by the scientists or the statisticians who perform the analyses. And so I know that there's been a movement away from kind of the roots of probability, at least I'll call it the modern roots of probability. Probability has been around much longer, but the roots of mathematical probability in gambling in the 1600s, 1700s. There's been a movement away from that, thinking that, there's many more applications of probability that don't really require that, whether you want to call it that lowbrow type of an activity. But at the same time, there is something very much, I think, that's ingrained in these concepts that makes them, in some ways, I really believe, inseparable, because the very fact that things are uncertain, not only are the outcomes uncertain, but the meaning of the statement is uncertain. What does it mean to say something is 80% to happen? That in and of itself is ambiguous. And so that's where I think the notion of risk, putting risk in actually making that statement gives the statement more meaning. Okay. And I think that, this idea of a free roll, which is a bet that you can win, but you can't lose in gambling, is something that actually comes into play in science, where, of course, if I'm a scientist and I can publish a paper in Nature and every word of it is wrong, I don't know if anybody would necessarily do it on purpose. Oh, of course, there's people who would do it on purpose, but not everybody would necessarily go out of their way to do that on purpose. But if, there's definitely some in between there, that there's certainly benefits to publishing something that's wrong, that don't really aren't really offset by the consequences if it's later found out that you knew they were wrong when they got published and things like that. And this is something that I think definitely plays into the replication crisis in science. It plays into a general credibility crisis in scientific peer review. And I think it also plays into some of what's going on right now with the COVID-19 and the election, COVID-19 policy recommendations by various organizations or individuals, and also, as we discussed, the election predictions. And so I just added this slide, which isn't really central to the discussion, but that just to see that this actually goes far beyond, I think, the political discussion of who wins or who's going to win the election, but just to see that if you look back at what people were saying in February and March and what people are saying now, and not only that, but the people who were maybe very wrong about what we should have been doing then when it comes to the virus, have been promoted to very important positions. Cass Sunstein has been tapped to be one of the advisors of the World Health Organization. The World Health Organization itself repeatedly kind of downplayed the importance of taking certain countermeasures and so on. Now, again, it's easy to criticize after the fact, but the point being that they're really, that these are important decisions. They involve uncertainty, and the consequences of the consequences for the general public are always present, but the consequences of those who are maybe making the decisions aren't always there. So that's where, just to bring this kind of full circle, this is what I've called the fundamental principle of probability, the idea that a probabilistic claim really needs to have some kind of consequence, some real world consequence, in order to make it substantial or meaningful in some way. And I think that if we could find if there were ways to actually do this, and I think there are ways to implement this idea in some context, not in all, it would actually have improvement. At the very least, I think it would have addition by subtraction, because it's very easy to maybe make a prediction on something if there's no risk associated with being right or wrong. But if I was actually forced to put money up to say, well, I think that, in this case, I think Joe Biden's definitely going to win the election. Or, like we said here, in the Betfair market, you could do it right now. If you think he's already won the election, you could go make a 5% return for free, and you'll be paid out within the next month or two. Do you really believe it? Do you believe it enough to actually put the money out there? And so I think that's an important idea. It's something that's important to the real world kind of applications of probability, and it's something that, I just think should be thought about and discussed more often. But thanks to everybody for listening, and I guess we should, I'll stop here. It'd be good to see what everybody else has to say about it.